Would you pay $9,000 a year to use an API? It may sound absurd, but let me show you the real numbers because this is already happening right now with millions of American families, and most haven't realized it yet. We're talking about artificial intelligence, that technology that everyone swore would be free, democratic, and revolutionary. The one that was sold as the future of humanity. The one that, according to the Silicon Valley CEOs themselves, was going to change everything. Yes, it has changed your bank statement. Because while you were getting used to using ChatGPT for free, while you were integrating AI into your work, your routine, your way of thinking and producing, the companies behind this technology were calculating exactly how much you would be willing to pay when you could no longer live without it. And now the bill has arrived. Today, in this video, I'm going to show you how artificial intelligence has gone from being a technological promise to one of the biggest financial plays of the last decade. I'll show you what's happening behind the scenes, how much money is at stake, and what this means for your wallet, whether you're a consumer, an investor, or someone who simply wants to understand where the world's money is going. If you haven't subscribed to this channel yet, do it now. Hit the button, activate the bell, because here we talk about money without beating around the bush, and without conflicts of interest. Let's start with a number that will make you uncomfortable. OpenAI, the company behind ChatGPT, is spending approximately $5 billion a year just on operational costs, servers, electricity, engineers, infrastructure. $5 billion a year. And the revenue, around $3.5 billion. This means that the world's most famous artificial intelligence company is losing $1.5 billion a year. Every year. In the red. Consistently. Now answer me this. When a company's losing money on an industrial scale, who ultimately pays the bill? You, the user, the consumer. Always. And that's exactly where the story gets interesting and scary. Because what's happening now isn't an accident. It's not mismanagement. It's a deliberate, calculated strategy, executed with surgical precision. And it has a technical name in the business world. Land and expand in a free translation. It enters for free, creates dependency, and then increases the price. First, they gave you everything for free. Unlimited access, no registration, new credit card. You used it. You liked it. You integrated it into your life. You started to depend on it. Then came the Plus plan, $20 a month, just to have access to the most advanced model. Okay, that seemed reasonable. Then came the Pro plans, $200 a month. $2,400 a year just for ChatGPT. But then you add it all up. There's Microsoft's Copilot, there's Google's Gemini, there's Anthropic's Claude. There are the AI tools integrated into the software you already use: Adobe, Notion, Salesforce, HubSpot. Each one charging its share monthly. Do the math. $20 here, $30 there, $15 elsewhere. Another $50 in the company's system. Suddenly, you're spending $200, $300, $400 a month on AI subscriptions without realizing it, without questioning it, because each individual charge seems small, seems justifiable, seems necessary. This is exactly how the trap was built. Now let me put that number into real perspective, because here we're not just talking about technology, we're talking about personal finance. $200 a month in AI subscriptions is the same as $200 a month is what a family of 4 in cities like Columbus, Ohio, or Memphis, Tennessee spends on electricity in the summer. That's the average monthly cost of broadband internet plus a cell phone plan for one person. It's almost half the monthly cost of a basic food basket for an American adult. According to the most recent USDA data, $200 per month equals $2,400 per year. $2,400 invested monthly in an ETF that tracks the S&P over 10 years with an average historical return of 10% per year. Do you know how much that turns into? more than $48,000. $48,000 that you could have accumulated in assets. Instead, it went to the servers of a company that is still operating at a loss. And there's another point that most people completely ignore: the degradation of the free model. This is not a conspiracy theory. It is a documented strategy, openly acknowledged by market analysts and even former employees of the big tech companies themselves. Here's a simple story. As the company launches more robust paid plans, the free version becomes slower, more limited, and more frustratingly inferior. Not because the technology is worsened, but because the inferiority of the free plan is a feature of the paid product. It's the deliberate discomfort that pushes you towards a subscription. It's like those music apps that increase the volume of ads, shorten free skips, block offline mode, to the point where paying seems like the only rational way out. You're not choosing to pay for convenience. You're being conditioned to pay to escape the discomfort they themselves created. And this has a name in the world of consumer behavior: manufactured frustration, lad-made annoyance, designed to convert free users into paying subscribers. But the most disturbing part of all this isn't the price. It's what you're giving in return. Because when the product is free, or even when you pay less than the actual cost, you're not the customer. You're the raw material. Every conversation you have with an AI, every question you ask, every document you process, every idea you type, all of this is being stored, analyzed, categorized, and used to train future models and to build a detailed profile of who you are, what you want, and how much you are willing to pay. Your data is worth money. A lot of money. And the cost of this transaction never appears on your bill. Now I want you to pay close attention to this part, because what I'm about to explain to you is the most powerful and most dangerous financial mechanism in the modern digital economy. It's Khaled's subscription economy. The subscription economy. And she wasn't born with artificial intelligence. It was perfected over decades, tested on you, validated with your data, and is now being applied to the biggest technological gamble in human history. Let's go back in time a little. Remember Netflix in 2011? $8 a month. Unlimited access, no ads, no frills. It was almost a joke how cheap it was. Everyone signed up. Everyone canceled their cable. Everyone got used to it. Today, the standard ad-free plan costs $22.99 a month. The ad-supported plan, which they swore they would never do, costs $7, but it serves you ads in the middle of the movie you're paying to watch. And even so, Netflix continues to lose subscribers in some quarters and continues to raise prices in others. Spotify. In 2011, it was completely free. Today, it's $11.99 a month for the individual plan, $17 for the family plan. And even if you pay, you still hear ads if you forget to renew. Adobe. Remember when you bought Photoshop once and used it forever? Today, it's $64.99 a month for the full plan per month, every month, forever, as long as you need to work with design. Microsoft Office. Same path. Google with its workspace plans. Salesforce, HubSpot, Zoom, Slack, DocuSign, the list goes on. And do you know what all these companies have in common? They all started by offering real, genuine, undeniable value. They all created dependency before creating a price, and they all increased prices at the exact moment the cost of leaving the so-called became apparent. The switching cost was too high for most users, because that's what the subscription economy does best. It doesn't tie you down with a contract. It binds you with habit, with integration, with history, with the simple fact that your professional and personal life has already been built on that product. Canceling becomes like surgery, painful, expensive, and time-consuming. And AI companies have learned this lesson better than any other generation of technology before them. But there's a fundamental difference between Netflix and a difference that changes everything when you look at it from a financial perspective. Netflix, when it raised its prices, was already profitable. It had already proven the model. It already knew that the revenue covered the costs. OpenAI is raising its price while still operating at a loss. This isn't confidence in the product. This is desperation disguised as strategy. It's like a restaurant that hasn't paid its rent for the month yet, but is already raising menu prices because the accountant said it's now or never. And when desperate companies raise prices, they don't stop until they encounter real market resistance, or until the entire model collapses. That's why I use the term that scares Silicon Valley executives the most when it appears in a financial newspaper headline: the Wall Streetification of artificial intelligence. What does this mean? This means that AI has ceased to be a technological race and has become a financial race. It means that decisions about what to build, how to charge for it, who to serve, and how quickly to evolve are no longer being made by engineers and researchers. They are being made by fund managers, boards of directors, and Wall Street analysts who need to show revenue growth in the next quarter. And when Wall Street enters the game, the rules change. The user ceases to be a person to be served and becomes a metric to be optimized. The product ceases to be measured by its usefulness and begins to be measured by ARPU, average revenue per user. Innovation ceases to be the objective and becomes the selling point for the next funding round. We've seen this movie before. We saw it with social media. We saw it with delivery apps. We saw it with first-generation fintechs. And in all these cases, the story ended the same way. The consumer paying more, receiving less, and with no real alternative to leave. If this content is opening your eyes to how money really works in this new economy, leave a like now. It really helps the channel grow. And tell me in the comments, do you already keep track of how much you spend per month on AI subscriptions? It might be more than you think. Now, let's talk about real money. Because up until now, I've shown you the consumer side, the side of the person who pays the bill. But there's another side to this story, the side of the person receiving this money, and that side is even more revealing. Let's talk about bubbles. It's not a word I use lightly. It's a word that destroys portfolios, eliminates jobs, and wipes out fortunes when it appears in the wrong place at the wrong time. And today, in 2025, it's being whispered in the hallways of Wall Street with a frequency that should concern you. NVIDIA, the company that manufactures the chips that power virtually all of the planet's AI infrastructure, was once valued at over $3 trillion in market capitalization. $3 trillion. For context, Brazil's entire GDP is approximately $2 trillion. NVIDIA, on paper alone, is worth more than the entire annual economic output of the world's 12th largest country. Microsoft invested $13 billion in OpenAI. Amazon put $4 billion into Anthropic. Google invested billions in the same, all betting that AI will generate a return proportional to the investment. But here's the question that no analyst can yet answer clearly. Where is the revenue that justifies these valuations? Because when you look at the real numbers, not the hype numbers, not the numbers from the balance sheets, the story becomes much less glamorous. OpenAI, as I said, is still operating at a loss. Anthropic, the company behind Claude, has a different approach. It focuses on Hivalu corporate and government contracts, making it less dependent on the end user. But even so, it has not yet publicly reported consistent profits. And Google, which has Gemini integrated into all its products, has yet to prove that AI is generating enough incremental revenue to justify the billions it has poured into the sector. This doesn't mean AI has no real value. It does. Immense value. But real value and market valuation are very different things. And the history of financial markets is full of genuinely transformative technologies that nevertheless destroyed the fortunes of investors who got in too early, paid too much, or simply didn't understand the difference between a technological revolution and a good financial investment. The internet changed the world, but those who bought Pets.com stock in 1999 lost everything in 18 months. Railroads transformed America in the 19th century, but the railroad bubble of 1840 broke banks ruined investors, and left a trail of financial destruction that took decades to dissipate. The question every investor needs to ask today isn't, will AI change the world? The answer to that is already yes. The question is, at what price are you buying this change, and who will capture the value it generates? Because there's a huge difference between investing in a revolution and paying the maximum price for hype before the market decides who actually survives. Are we facing the next dot-com bubble? Perhaps not in the same format, but all the ingredients are there. Assessments disconnected from the current recipe. A race for market share, independent of profitability. And this time, it's different narrative repeated by those with a financial interest in you believing it. The difference between 1999 and now is that this time the companies are larger, the investors are more sophisticated, and the technology is genuinely more powerful. But sophistication doesn't immunize against euphoria, and technological power doesn't guarantee proportional financial returns. Now, let's get to the part that bothers me the most in this whole story, because everything I've told you so far about price, about subscriptions, about bubbles, all of that is still the visible side of the equation. It's what appears on your bill in the financial news, in analysts' reports. The invisible side is more valuable, and you're giving it away for free every day. Your data. Every time you use AI, any AI, you are generating information. Information about how you think, about what problems you have, about your industry, about your financial concerns, about your fears, your ambitions, your business strategies. No market research in the world can capture the level of detail that a conversation with an AI captures from you in 10 minutes. And this data has an economic value that goes far beyond your monthly subscription. Because data is the new oil. You've heard that phrase before, but maybe you haven't stopped to think about what it really means when applied to your everyday digital behavior. This means that while you pay $20 a month for access, the company is building an asset worth billions. Build with your questions, your documents, your ideas, your strategies. You're paying to work for them for free. And the most sophisticated part of this operation is that soon, and in some cases it's already happening, this data will be used for targeted advertising within the AI platforms themselves. Imagine this. You're talking to an AI about refinancing your mortgage. 2 days later, the AI starts suggesting financial tools, banks, consultants, all paying partners of the platform, not as an explicit advertisement, as a recommendation, as a natural part of the conversation. This isn't science fiction. It's a business model that has already been tested and validated by Google with search, by Facebook with its feed, and by Amazon with product recommendations. And AI is the most powerful tool that has ever existed for executing this strategy because it doesn't show you an ad. It persuades you using natural language. The difference between a banner ad and a conversational AI recommendation is the difference between a billboard on the road and a trusted friend suggesting something for dinner. You ignore one, you consider the other. And this is where I arrive at the conclusion I want to leave in your mind when you close this video. The era of free artificial intelligence is over. It's not ending, it's over. What's coming next is an economy where access to AI will be as structural as access to the internet. And just like the internet, it will be charged for, monetized, and used as an advertising vector at every possible level. The question is no longer whether you'll pay for it, it's how much you'll pay, in how many different ways, and whether you'll have enough financial awareness to make that decision intelligently instead of being dragged along by convenience and habit until you realize you're spending $500 a month on tools you don't even use properly. As a consumer, you need to audit your subscriptions now. List everything, calculate the annual cost, compare it to the real value each tool generates in your life, and have the discipline to cut what doesn't justify the price. As an investor, you need to separate the narrative from the numbers. AI will transform the world. That's almost certain. But transforming the world and generating returns for the retail investor who buys at the peak of the hype are very different things. Understand the fundamentals before allocating capital to any company in the sector. And as a citizen, you need to understand that your data is an asset, and that every time you trade privacy for convenience, You're making a financial transaction, but without seeing the other side of the coin. The question that remains is simple and direct. Will you be a passive consumer of this revolution, paying whatever price they tell you without questioning? Will you be a conscious investor, separating hype from reality to make intelligent decisions? Or will you stay out of it, ignoring a transformation that will reshape salaries, jobs, markets, and fortunes in the coming decades? There is no single right answer. There is the answer that makes sense for your current financial situation, your goals, and your risk tolerance level. But there's one thing that's inexcusable: being caught off guard. You've already been warned. If you've made it this far, you deserve a medal, and I deserve a like. Hit that button. Leave a comment with your opinion. Would you pay $200 a month for an AI, or would you prefer to put that money in ETFs, treasuries, or dividend stocks? Tell me in the comments, and check out this video that's appearing on the screen now. It can probably help you with any other questions you might have about bail in your daily life. Click there and continue with us. See you there!